We're going to get started with Jonathan Rogers from Taylor Wessing.
Thank you, Eddie. Good evening, everyone. My name is Jonathan Rogers. I head up the financial services practice at law firm Taylor Wessing. We're a bit about us there. We're Law Firm of the Year this year. I won't be able to say that every year, so I might as well say it when I can. We have a particular interest and practice in financial technology, data protection, digital technology and financial services. I fall into the last category, so my theme tonight will be looking at things really from the perspective of the regulator and from regulated businesses. Some of you may work within those businesses, some of you may be trying to create products and tools that they can use, so hopefully what I say will be interesting in the round. A bit more about a wonderful data hub. We've got lots of information about data, control and compliance there if you're interested. What I'm going to talk about is, first of all, how our regulators in the UK approach data security and how they see it as a concept. I then want to just trip gracefully through 3 or 4 hotspots where regulatory change is generating, in my view, opportunities for people who've got technology-driven solutions that might be of interest to some or all of you. And it's just good examples as to how technology meets regulation. I then want to just close off with some general observations if I've got time. I've got lots of time because Eddie the starter hasn't gone. Great. Well, I'll just get going then. As a lawyer, we tend to sort of end up writing large bits of text, but I'll just run you through this. So in the UK, our regulator currently is the FCA, the Financial Conduct Authority. That's the authority that deals with most interactions between financial services firms, whether they're banks, insurers, IFAs, and the customer. They've got a number of statutory objectives, which are listed there: market confidence, public awareness, consumer protection, and the reduction of financial crime. Looking some way back to a report they did on data security in financial services, they've picked up a number of themes that they see as being potentially themes that could risk their statutory objectives, and this is why they're interested in this area. They've got an obligation to reduce financial crime. They must ensure consumer protection. Obviously, data loss could be a significant issue, particularly on a large scale. And also market confidence, and that could be at consumer level. Every time one of our banks refuses to allow you to process your transactions or access your accounts, or a market level, if the markets freeze because of a technology hitch, that's going to be an issue and affects market confidence and ultimately the attractiveness of doing business in the UK. So what the FSA is looking for is not just, if you might say, risks to the banks, but they've also got a broader interest in securing and creating confidence in the financial sector. What do they think of data security? Well, regulated firms have to make sure they've got good systems and controls to ensure they comply with their obligations, but also to ensure the risk against the risk of financial crime. These systems and controls must be comprehensive and proportionate to the nature, scale and complexity of their operations. In shorthand, what that can mean is whenever you've got a good, innovative idea, you take it to a bank, you get swallowed up by procurement, who are in charge of systems and controls, and it can be quite hard work to work through these organisations because they've got this broad duty to look after their business and control it properly. In particular, just a final bullet in terms of capital there. These days, the regulator looks to regulate through applying capital requirements on firms. So if firms have a business model, maybe they're outsourcing data to the cloud, they're doing something slightly innovative, the regulator might require them to hold more capital against that risk, even if it's quite a soft risk. So it's often the case that innovation costs regulated institutions not just through pounds and pence, but also in terms of capital they've got to hold. And you need to bear that in mind. In terms of particular points on data security, again, if you're interested, I've noted a report there by the FSA, the FCA's predecessor, on data security in financial services. There's a list here of things they are interested in. There's a particular theme here about large banks, big data, using the cloud to store data. That's a running theme at the moment. But they're requiring firms to look at encryption protocols, physical security standards throughout both the bank's own systems, but also when they outsource data to the cloud, how secure are the physical sites, what security applies on transit, not just at endpoint, third-party suppliers, who are they? If you're beginning to really host data remotely, where exactly is the data, what third-party suppliers are involved, and banks need to think about what due diligence they're doing. There's also challenges regarding third-party staff access to data. Is that possible? Who can access it? How are they vetted? Can they make copies of data? All these sorts of issues arise. There's controls for ensuring destruction and tracking of hardware. There's the issue of internal audit and compliance monitoring. So if you've got an idea, it's well worth asking yourself, how could a big FS institution come and audit? What would their compliance team want to do? How could I make it easy for them? And then there's a backup data requirement. And perhaps, again, just to illustrate why these large institutions are so interested in data security, there's precedent for the institution being fined. Here's Zurich, where in fact the data breach occurred at a delegated outsource provider, I think in South Africa, but it was Zurich, UK, that was fined quite heavily because it failed to take proper control. So that's the kind of issue that they have to think about. In particular, in terms of data security, again, some of you may come up against this. The regulator has a concept of what it calls a material outsource, and it will require pre-approval or pre-notice, at least, of any material outsource that regulated firms enter into. It's defined by anything that could materially impair the continuing compliance of the firm with its obligations, financial performance, or the soundness or the continuity of its services. So if any departure into new technology involves an outsource to a third party, that could trigger the need for the bank, the insurance firm, whoever it is, to go through a particular set of rules to make sure that outsource meets those rules in terms of good governance, exit procedure, liability, step-in rights, those sorts of issues. But they've also got to tell the regulator about it and explain what's going on. So that's the kind of burden they'll be subject to. The sorts of issues that can arise there in the green box. Can the outsource be exited? The institution will be thinking about if you like decosted its own resources and is using the solutions that other people can provide. If it needed to step in, could it actually do that? Does it have the skilled staff? Does it have the hardware? Does it have the systems to do that? The question whether the firm, the auditors, the regulator has access if they want to have access and they are entitled to that. BCP, disaster recovery planning, no procurement team will say yes unless they're satisfied there are backup plans, backup data and so on. But also the firm has to retain expertise to supervise the outsource and understand what's going on and manage that. So again, this is just life as the regulator sees it, and through the regulator how large institutions see it. On a slightly different brief now, perhaps more looking at what the regulator thinks of startups, of new ideas. The first and disappointing bullet is that the requirements are media neutral. So it doesn't really matter if in the old days people were trading with physical presence in a trading room, paper-based chits at Lloyd's of London, and now they can do it online, they can do it through their apps. It doesn't matter. The rules are the rules. And that's often forgotten when clients come to me for ideas. They perhaps think that because it's a new media, a new way of doing things, the rules don't apply. And it's often with heavy heart when I say, well, this is really no different to anything else out there. The FCA are really keen these days on expecting new ideas to look at consumer needs. Ultimately, they're a consumer regulator. So they'll be if you've got a plan you want to either get regulated, you've got a solution that needs it, or you're selling it to a firm that wants it, you have to think about what does the consumer actually want from this regulated service, and how does my product support that? You've also got to identify proactively what the so-called consumer weaknesses are. A very easy example is around perhaps the annual process we all go through of renewing our household insurance, for example. A consumer weakness is as simple as the fact we don't read what's sent through, and the regulator expects firms to protect against that by making sure that Everyone has things properly disclosed to them. So they're expecting firms to think carefully, what is it about my consumers that is a weakness? What won't they do? What won't they read? And then you can't take advantage of that. You've got to actually plug that gap and make sure they get the support they need. That really applies to protecting consumers' interests. You've got to act in their interests. Also, just in terms of disclosures, there are lots of rules that require consumers to receive things in a durable medium that they can print off, they can store, they can keep. Lots of firms are beginning to create, you might say, online strong boxes where consumers can keep their banking documents and other documents they get, so that the regulator is permissive in that respect, but you've still got to be aware of at least when people need to have something stored in a durable medium. The regulator would expect any business plan to address the risk of fraud and what you're going to do about it, address the risk of security. How can a consumer keep their password, their PIN codes, whatever it is they need to access your solution? How do they keep that safe? Are you telling them clearly enough that they need to keep it safe? How's that being managed? Are there third parties? Do you delegate to anyone else? You need to involve them in your business plan and make sure they're covered too. They'll be looking for the consumer capacity, both in terms of a fraud risk, but also they want to you to think about how they use technology, whether even if the screen on a mobile phone is too small for them to be able to see the information they need to see, how do you think around that? If they key in an error, what are you going to do about that? Is that their fault or is it your fault, and will you correct it? What's your thinking there? You've got to think about these things. Testing and backup, the regulator would expect to see that's all been processed through. And of course there's anti-money laundering. It applies to all regulated firms. So you've got to think about anything you're doing. Could it have an impact on a firm's anti-money laundering obligations to identify clients, and how can you support that? If you're interested in any of those themes, the FCA issued a paper in August this year, principally on mobile banking, but the concepts it talks about are relevant to any kind of new tech idea. Now, again, a change of tack. I just want to go through three different areas where I see regulations changing in a way that creates a vacuum where lots of new technology can pile in, as far as I can see. Payments, mobile payments, crowdfunding, and then some general observations that I hope I won't have time for. Payment services, firstly. The payment services has only been regulated across Europe since 2009. So it's a fairly new set of regulations. Prior to that, your banking account was regulated, but not the actual, you might say, bits in between bank accounts, how payments were transferred, who had obligations to you. That came in 2009. The EU is already reviewing that regime, and they want to make it more competitive. And what I think I can say is that they've got in their sights is our tendency to turn to our credit and debit cards to process all our payments. All of those cards, well, a lot of them operate on a very few scheme providers. You're really looking at Visa, MasterCard, Amex for some schemes. And the regulator feels that the market needs to be more competitive. And there have been some cases in Germany where there have been competition issues at heart. What it wants to do is create a framework that allows different alternatives to enter the market. The first one is payment initiation services. This is where if you're going onto a website, you want to buy something, rather than add in your payment card details and off it goes round the loop through the MasterCard network or Visa, picking up fees and charges along the way, a software solution steps in, takes your security password off you and goes to your bank, into your bank account, and pushes a payment over to the merchant you want to pay. So rather than go round the loop, it shortcuts it, and you can just make a payment as if you went into your own bank account and just pushed a payment through to someone. The charges are much less, and it's a much easier way of doing business. It does mean that consumers who don't get debit cards, credit cards, can make payments online. The merchants like it. Currently they pay large fees for MasterCard, Visa payments. They don't have much control over that process, so it's cheaper for them as well. There are, I mean, you might say the contentious spot about this, and you've probably spotted it, is that you've got to give your security details to a software provider, and they can then go and use that at your bank. The banks don't like this. They don't like people giving away security data for third parties to operate a bank account. They'd rather you landed on their own internet page or use their own app where they can, if you like, enhance their brand with you, own you as a customer, cross-sell products to you and create an experience for you. There's nothing wrong with that. But by interposing a software solution, you never get to the bank page. You actually add your details in somewhere else and someone else does that for you. So the banks are not keen, and there's a security risk there. Nonetheless, the EU has said this is the way we're going, and the rules require banks to accept these third-party payment initiation services. So there's a lot of new technology there that can step in. We're certainly aware of lots of firms in the US who currently have various types of methods to access your bank accounts, are interested in the EU market. The next one there is account information services. This is where it's not dissimilar, where you can aggregate all your accounts into one space. I recall years ago working at Egg Bank probably about 10 years ago when they did this, and that caused a storm. None of the banks liked it, again, as Egg was sitting in between the consumer and their other banking relationships and aggregating access to all your financial accounts on a single site. Again, the EU have created a permissive regime for this, whereby the banks are going to have to accept it. There's also a challenge, finally, to the interchange charges. These are the charges that banks can apply to these sorts of card payment schemes, bank card issuers. They're currently expensive. Caps would apply, and that should create more competition and also create more sort of routes to making payments work. So that may interest you, it may not, but the point is, because of a very clear EU-level strategic intent to create more competition, the regulations are driving innovative change here, and it's very interesting to see a regulator doing that. They're opening the gates rather than shutting them. The next topic I wanted to talk about very briefly was just on mobile payments. And we see this an awful lot with people wanting to facilitate payments through remote means, through your app, through near-field technology. There's a great difficulty in balancing the need for security, ease of use, and also consumer confidence. Lots of our clients want to break down the barriers in terms of removing PIN codes, removing the speed bumps, you might say, to making a transaction. But it's not always, on the basis that consumers just want to swipe and go. But a lot of consumers actually quite like the sense that there is the security passcodes there, and that enhances their confidence. So you've got to balance all of these three things. The reason in particular why banks are so keen to make sure their mobile sort of payment systems are secure is that they are liable for unauthorized transactions. If they remove the security steps, they've got no way or a more reduced scope for proving that you actually authorized your transaction. If a transaction occurs, I call up my bank, I say it wasn't me, and they say, well, how did someone get your password? How did someone get your PIN code? I've got a case to answer there. I have to explain that, well, I'm not sure what I explained. Somehow I managed to leave these around or someone got access to them. If there's no security, if I just call up the bank and say I was sitting in the library, someone accessed it, they made a payment, your system doesn't allow for security, so you can't prove I didn't do that and vice versa. But the bottom line is that the bank is liable and the burden is with it to discharge the proof that I've been negligent with my security. So this is the driver behind banks wanting to enhance security. PSBs with weak authentication procedures at the bottom there can't prove the customer has authorized the transaction. Going forward, the EC has decided it wants to, you might say, regularize what proper authentication looks like. It's got a theme. You need to use two or more of the following: knowledge, possession, or inherence. I don't know how you say that last one, but basically it means that there's something about you in particular that is used as part of the security test. And to have what's called strong authentication, you need to at least have two of these things applying to the payment method you're enabling your consumers to use, and they must be independent of each other. For example, and often that's just logical. For example, if knowledge is, what's my mother's maiden name, if possession is, I've got to have my app or my phone with me, and they will only recognise my phone through its phone number. Those two things, if I lose my phone, doesn't necessarily mean I've lost the knowledge about my password. So they have to be independent of each other. And the EC is saying this has to be a kind of obligatory process for authentication going forward, and there are some exemptions to be determined. We don't know what they are just yet. So just another example of the regulator leading the way in terms of what security looks like. Finally, on a different topic, crowdfunding and peer-to-peer lending. Crowdfunding, there's a bit of it's fairly high profile at the moment as a theme. The regulator, the FCA, has stepped in, has created two regimes that recognise investment-based crowdfunding when you're looking to raise money into startups, and also peer-to-peer lending. I'm happy to answer questions on these separately afterwards, because some people have perhaps an unclear understanding of just how regulation applies to these activities. Investment-based crowdfunding has always been regulated. It's just the FCA are perhaps underlining that and setting out a particular regime for clarity. There's been some uncertainty. For crowdfunding, the FCA have been cautious. Again, going right back to the start, they have a consumer protection obligation. They think sort of startup companies are high risk. I'm not sure what the stats are, but we all know they don't all succeed. So the question is, as a principle, they shouldn't be suitable for your average retail consumer. So they've imposed restrictions on who is actually in the crowd. So in a sense, it's somewhat of a misnomer. Crowdfunding suggests we're all involved. As it is, there's that question, are you in the crowd or not? You're looking at high net worth people, sophisticated investors, and there's also a new test to the effect that a retail consumer shouldn't be putting more than 10% of their disposable income after property, pensions, etc. taken into account. Furthermore, the platform, has an obligation to take some steps to check whether this sort of investment is appropriate for the individual. You're not advising them as such, you're not recommending it. You've just got to ask them some questions to test their level of understanding. Do they understand the risks? Do they understand what they're doing? Perhaps with reference to previous experience, for example. So the FCA have imposed an additional step into the process of a crowdfunding website, just to make sure it's being used by the people the FCA thinks it should be used about. On peer-to-peer lending, it may sound high risk lending to another person you've never met over the internet, but they have found that it's actually lower risk. Often peer-to-peer lending, it's pooled, so you don't lend all your money to a single person. There's a sort of diversification process involved. The operator of that platform needs to make it clear to consumers how it selects the borrowers. What are the criteria before they can come on board? There is some capital requirement, but also no compensation scheme cover. Probably a technical detail, but the regulator doesn't want to think that by offering its compensation scheme to peer-to-peer lending, that people can lend at will, thinking the compensation scheme will back them up. It won't. They really are exposed to the risk that the other person won't repay the money.
With the recent announcement that peer-to-peer lending may be eligible for the ISA umbrella, do you foresee any changes to regulation in this space?
I wouldn't think so. I think the FCA have set out their regime in terms of how they expect it to be regulated. I can't see them being persuaded by that. In a sense, an ISA is designed to be used by retail people, and the FCA in turn have already created their rules in the knowledge that it could be used by the consumers at large, and they haven't imposed. Whereas on the investment side, there is this question: who is in the crowd? There are limits on who can access it. That's not the case on the peer-to-peer side, so it lends itself quite well to ISAs. finally, some real sort of motherhood and apple pie comments there about things to think about if you're starting up a project. I'm not going to go through those. You can read them if you want to.
Thank you, Jonathan. Can we have some questions?
One question about crowdfunding. Some platforms are now opening towards Europe. I'm thinking, for instance, of Cedars, but it's a process that has taken it has been difficult and is taking quite a bit of time. How is regulation involved in that, and how does that helps or prevents startups?
I think what you would need to do there in terms of working out if you need a license is that there's a concept called passporting. So if you need a UK financial services license from our regulator, the FCA, if it falls into some European directives, you can passport the license into another country without needing to go and get a separate license there. So it's a freedom of services type setup. So if you get your license here, in theory, you should be able to go and provide the service into other European jurisdictions. They should have a common framework in terms of how you promote to people, the sorts of disclaimers you need to give. So there will be some differences across the EU, but in principle, the framework is there.
But they have to do it for all 28 countries, or the other 27 countries, right?
Yeah, that's right. But even then, I mean, you'll need to look at issues such as languages. But in terms of the process of communicating investments to people, there's a common rule set that applies to core investment activities across Europe. So that the whole passporting regime is predicated on the basis that each country has equivalent rules of this core common set. So in theory, you shouldn't find much difference. In fact, you could probably find that you can passport remotely across border without setting up a branch there, but just using the internet and just comply with the UK home state rules in terms of how you do your investment business.
Yeah, you mentioned the 3 different types of authentication: what you are, what you know, what you have. But there's lots of shades of grey in each of those dimensions. Does the FSA say anything about that? Because
they don't yet. The driver comes from an organisation called the EBA, the European Banking Authority or Association, one of the two, and it's issued a paper on strong authentication. And that's actually where some of the quotes and the slides came from. As part of the payment services revisions process, the EBA needs to come up with some guidance and exemptions to the strong authentication process. And from memory, that the paper they've already got is quite a good paper. At least I find it quite good as a lawyer. It gave me quite good examples on what was required. I'm happy to send you a link to it if that would be helpful afterwards.
Hi, I have a quick question. I'm not sure if you've heard about a thing called Coin. It's a Kickstarter project. It actually aggregates all your credentials, especially the US credit cards in the US just have a magnetic stripe. Do you see something like that being feasible in the UK? What it means is like you aggregate all the credentials of all the payment systems that you have in your wallet, put that on a device, and you allow people to use it. Will it be legally possible is the question.
Yeah, I mean, I probably need to know a bit more about exactly what it does in terms of people using it.
Okay, so essentially what it does is like, in the US, just because there's no pin and chip, all you have like a magnetic strip is the authentication that has some details on the back of it. So you can copy it across whenever you want. And these guys capture the whole thing and translate it across to a hardware device. Mm-hmm. And they have a whole network that will actually proxy you. Whenever you do a transaction, they proxy you for the transaction.
Yeah, I mean, it may be what the service amounts to is one of the payment initiation services whereby a third party stores authentication details and can use those to actually instruct a payment. What I don't know is whether your product, how it's used. Do people then, does the provider use that to actually allow people to instruct payment
I don't know
transactions?
Yet. I don't know yet.
That would be interesting to know. But you could fall into the payment initiation service I mentioned in the slides. in which you need to get a license in the UK to conduct a payment initiation service. But if you get that, you can do it, and the rules are permissive in that they require the bank to respond to you in a positive way. So that might be of interest to you.
Okay, Jonathan, thank you very much.